This checklist is the difference between traders who consistently pull money out of the market and traders who keep wondering why their setups never work. 5 specific points. Every trade, in order. If even one is missing, you don't enter. Period. But here's what most traders don't know. Point 3 on this list is the one almost everyone skips. Not because they're lazy, because they genuinely believe they're already doing it. They're not. And that single blind spot is quietly responsible for more blown accounts than bad stock picks, bad timing, or bad markets combined. I've spent years studying high probability trade structures, breaking down what separates entries that consistently work from entries that look identical on the surface but fail every time. This checklist came from that. It's not theory, it's tested, repeatable, and it works. Point 1. Trend alignment. Here's the simplest rule in trading. You do not fight the trend. Ever. And yet, watch any beginner's trade history. What do you see counter-trend entries? Every single time. They see a stock dropping and think, it has to bounce. They see a runner and think, it's too late to buy. That thinking kills accounts. Before you enter any trade, you need to ask one question. What direction is price moving on the higher time frame? If you're a 5-minute trader, look at the 15-minute. If you're a 15-minute trader, look at the 1 hour. Your entry time frame should always be aligned with the directional bias of the time frame above it. Bullish on the higher time frame? You're only looking for long entries. Bearish? Short entries only. Simple, ruthless, non-negotiable. If the trend isn't clear, if you're staring at a chart going sideways and genuinely can't tell which direction it's heading, that's your answer. You don't trade it. You wait. The market pays you to be selective, not to be active. Trend alignment is the foundation. Everything else builds on top of it. Which brings us to point 2, and this is where most traders start to separate themselves from the crowd. But point 2 only works if you understand what you're actually looking for, and most people have it backwards. Point 2. Key level confluence. A trade without a key level is just a guess with a brokerage account attached to it. Key levels are the areas on a chart where price has made significant decisions before. Support zones, resistance zones, previous day highs and lows, pre-market highs, supply and demand zones. These are not random lines on a chart. They are the fingerprints of institutional money. Big players park orders at these levels. That's why price reacts there, repeatedly. So here's the rule. Your entry must occur at or near a key level. Not somewhere in the middle of a range, not close enough, at the level. And here's where confluence becomes powerful. When multiple key levels stack on top of each other. When VWAP sits right at a previous day's high. When a supply zone lines up with a round number. When the pre-market high is also a weekly resistance level. That overlap, that's confluence. And confluence dramatically increases your probability of a successful trade. 1 level is interesting, 2 levels is significant, 3 levels is a high probability setup. If your entry doesn't have at least 1 strong key level, preferably 2, you don't have a trade. You have a hope. Now, remember point 3 I mentioned at the beginning? We're almost there, and I promise you, this one is going to make you rethink how you've been trading. Point 3. Confirmation signal. This is the one most traders get completely wrong. Here's what typically happens. A trader spots a great setup. Price is at a key level. Trend is aligned, and they enter immediately. Before price does anything to confirm it's actually going to move in their direction. They're not entering on confirmation. They're entering on prediction. And prediction in trading is just a sophisticated word for gambling. A confirmation signal is a specific, observable price action event that tells you the level is holding and momentum is shifting. What does that look like? A bullish engulfing candle off support. A rejection wick at resistance followed by a close back below it. A break and close above a consolidation zone after multiple failed attempts. Volume surging as price moves through a key level. These are confirmation signals. They tell you that something is actually happening, not that something might happen. The mental shift is this: you are not predicting the next move. You are reacting to evidence that the move has already begun. Let that land for a second. You are not here to be first. You are here to be right. Waiting for confirmation costs you a few ticks of entry price, but it saves you from dozens of trades where you entered perfectly positioned setups that simply never triggered and stopped you out while you watched price do exactly what you thought it would do. Just not yet. Patience at this stage is not weakness. It is discipline. And discipline is the only edge that doesn't expire. You've got trend alignment, you've got key level confluence, you've got a confirmation signal. 3 boxes checked. But here's the thing. Traders who only know these 3 points still blow up because they skip point 4. And point 4 is the only point on this list that isn't about finding the trade. It's about surviving it. Point 4. Defined risk before entry, not after. Before you click buy or sell, you need to know 3 things. Exactly 3. Where is your stop loss? Where is your target? And what is your risk to reward ratio on this trade? If you can't answer all 3 in under 10 seconds, you are not ready to enter. Your stop loss goes at the level that invalidates your thesis. If you're long off support, your stop goes below that support. Not a few cents below because it feels safer. At the logical invalidation point, your target goes at the next significant key level in your direction. Not some arbitrary number, a real level that price has respected before. And your risk to reward? Minimum 1 to 2, preferably 1 to 3 or better. This means for every dollar you risk, you need to be targeting at least $2 in return. Why does this matter so much? Because even if you're right on only 40% of your trades, a 1 to 2 risk to reward makes you profitable over time. The math works in your favor. Without defined risk, you are leaving your survival up to emotion. And emotion in trading makes decisions that destroy accounts with surgical precision. Know your risk. Define it. Then enter. 4 points. 4 boxes checked. And there's 1 left. Point 5 is the one most traders completely skip because it doesn't feel like trading. But removing it from your checklist is like removing the brakes from a race car. Everything works perfectly, right up until it doesn't. Point 5. Market conditions check. Every single checklist point we've covered, trend, level, confirmation, risk, all of it depends on one underlying assumption, that the market is actually tradable right now. And that's not always true. High probability setups fail at a significantly higher rate during certain market conditions. Major news events, Fed announcements, earnings releases, pre-market and post-market low liquidity windows, choppy, directionless days with no follow-through. Before you enter any trade, you need to check. Is there a scheduled news event in the next 30 minutes that could invalidate everything? Is the market showing clean directional movement? Or is it whipsawing with no structure? Is volume supporting the move but not? Or is this a ghost town with a few rogue trades creating false signals? If the conditions are compromised, even if every other box is checked, you wait. Or you reduce your size dramatically. The best traders in the world know that not every day is a trading day. Knowing when not to trade is as valuable as knowing when to trade. Possibly more so. Protect your capital on the bad days, because your capital is what lets you show up on the good ones. Let's run through it one final time. Point 1. Trend alignment. Higher time frame first. Always. Point 2. Key level confluence. At least one strong level. 2 is better. Point 3. Confirmation signal. React to evidence. Never predict. Point 4. Defined risk. Stop, target, and risk to reward before you enter. Point 5. Market conditions check. Know when the market is not giving you anything worth taking. 5 points. Every trade. No exceptions. Here's what changes when you actually follow this. You stop taking trades out of boredom. You stop entering because you're afraid to miss a move. You stop gambling with your own money and calling it a strategy. You become the trader who waits for the setup and executes with complete confidence because you know, before the trade is ever open, that you did everything right. The outcome is no longer in your control. The process always is. That is what a high probability trader looks like. And now, you know exactly how to become one. I'll see you in the next one.